Yo, what's up everyone? Welcome back to the channel. It's your boy here, diving straight into the Bitcoin chaos that's been rocking the market in early 2026. If you've been watching the charts, you know the drill. Bitcoin tanked hard from those insane highs over 120K late last year, plunging all the way down near $60,000 just a couple weeks ago. People were freaking out. Liquidations everywhere, sentiment in the gutter, $8–9 billion wiped out in a flash. But here's the thing, I'm sitting here telling you right now, with BTC clawing back above 69K, 70K as we speak, I genuinely believe we might have just seen the bottom at that 60K zone. And yeah, I'm buying more. Pumped doesn't even cover it. Grateful for this second chance under 70K? Absolutely. Quick heads up before we go deep. This isn't financial advice. Crypto's volatile as hell. I've been through enough cycles to know you could see more downside. Could it dip to 50K, 40K? Sure, black swans happen, but the data, the big players, and the macro setup have me stacking sats aggressively while the fear is still fresh. If you're new around here, smash that like button if you're feeling the bullish vibes after this dip. Subscribe and hit the bell. We break down these moments every week so you stay ahead. Let's rewind to that gut punch moment. Early February 2026, Bitcoin spirals towards $60,000, headlines screaming worst drawdown since FTX, analysts pointing to the 200-day moving average around 58K, 60K as potential support. It hit right there, briefly dipped to about 60K on February 5th or 6th, sparking massive panic. But fast forward to now, BTC's bounced hard, recovering 15–16% in under 2 weeks, trading around 69K, 70K range on the latest prints. Cooler inflation data helped, risk appetite returned, and suddenly everyone's asking, was that the capitulation bottom? I think yes, and here's why, starting with the miner floor that's been buzzing everywhere. Most people still don't realize this. Around 60K aligned almost perfectly with Bitcoin's estimated cash production cost at the dip's low. Miners were getting squeezed. Average cost to produce 1 BTC was hovering way higher earlier, like 87K, 90K in late 2025, early 2026 estimates, but difficulty crashed hard. Network difficulty dropped significantly, reports a 15% fall since the year started. Hash rate pulled back from peaks near 1.1 zettahashes per second. That adjustment? Pure genius in Satoshi's code. It makes mining easier and more profitable at lower prices, bringing efficient operators back online, while weak hands, high-cost miners shut down rigs. When price trades below production cost, marginal selling pressure evaporates. Miners stop dumping newly mined coins to cover electricity. Boom, supply shock eases, and historically, that's where bottoms form. Bill Miller from Miller Value Partners nailed it on CNBC. He straight up said there's a reasonable chance the bottom was hit at 60K last week, meaning early Feb. Reasons? First, that cash production cost floor forces weak miners out. Second, global liquidity shifts. The Fed's pivots and macro cooling played in. Third, on-chain metrics. More supply and unrealized loss than profit. Classic capitulation signal. But let's bust the myth right away. The mining cost floor doesn't matter because it just adjusts down. Yeah, it does adjust, and that's the beauty. It self-corrects. When hash rate drops, like the recent 20% drawdown before rebound, difficulty follows, lowering the break-even. Latest estimates from JP Morgan put average mining costs down to around 77K now after those adjustments. Miners are stressed at current prices, but efficient ones, next-gen ASICs, are still profitable even at 7 cents per kilowatt electricity. Older rigs? Losses, but that's healthy. Network gets stronger, more resilient. Now, enter Michael Saylor, the absolute legend. When people ask him about the miner floor around 60K, he shifts the conversation hard. Stop obsessing over miners. Look at what the banks are doing. He says as big institutions roll out credit against BTC, think Citi, Schwab, JP Morgan, BNY Mellon, they're going to dwarf miners' influence by a factor of 10. Why? Almost 20 million BTC already mined out of 21 million cap. New supply is a trickle. Miners matter way less now than in the early days. Saylor's on fire lately. On CNBC, he doubled down. We're not selling, we're going to be buying Bitcoin every quarter forever. Concerns about strategy, MicroStrategy, dumping? Unfounded. He expects BTC to double or triple the S&P's performance over the next 4 to 8 years. That's not hype, that's conviction from a guy whose company holds a massive chunk of the supply. Even with paper losses in the billions during this dip, he's all in. Bitcoin is the most useful capital asset in the world. And institutions are proving it. Goldman Sachs just dropped their latest filings, over $2.3 billion in crypto exposure as of Q4 2025 disclosures, rolling into 2026 context. Around $1.1 billion in Bitcoin, mostly via ETFs like BlackRock's IBIT, plus big chunks in Ethereum, even $153 million in XRP and $108 million in Solana. That's 0.33% of their portfolio. Small today, but directionally huge. They trimmed some ETF positions in Q4, but the fact they're holding billions and diversifying signals mainstream integration. S&P, the credit rating giant, is rating Bitcoin-backed loans and securitizations, over-collateralized with clear liquidation thresholds. Quote vibes, Bitcoin is starting to emerge as an asset that can be used as collateral. Tokenized bank money, real-world finance linking to crypto. This bridges TradFi and DeFi in a massive way. Credit lines on BTC, leverage without selling. That's 10x more price impact than any minor capitulation. Gary V energy fits in right, with just getting started. Picture the clip. Someone panics. Should we be panicked? Gary, no, I'm buying, just buying. Pumped. I didn't think I'd get another at-bat like this. Same here. Last dip, I hesitated. This time, under 70K feels like a gift. World going more tech, fiat cynicism growing, perfect storm for BTC adoption. Could it go lower? Real talk, yeah. Some analysts eye 50K in summer if macro drags. Polls show many think bottom isn't in. 38K even got votes. Volatility's brutal, but asymmetry screams upside. Halving cycle effects lingering, ETF inflows potential, clearer regs, Clarity Act buzz, nations stacking quietly. Short term, range bound, maybe 52K to 70K. Long term, sailor's call, massive outperformance. Personal vibe, this feels like 2018 to 2020 deja vu, but with institutions locked in. I bought lower before, held through pain, rewarded huge. This dip, same setup, bigger players. So what do you think? Drop in the comments. Bottom in at 60K? Yes, no, or more pain first? You buying this bounce? Holding tight? Averaging down? Your 2030 BTC target? Sailor conviction or Gary V hype? Which fires you up more? Like if this got you hyped. Subscribe for more breakdowns.